In this lecture, we're going to dig a little deeper into fiscal policy. First, we're going to look at automatic stabilizers, which is our non-discretionary fiscal policy. We're going to look at some of the past data in the U.S. We're going to talk about some of the problems of fiscal policy, and then we're going to practice doing a graph. First, let's talk about non-discretionary fiscal policy. Non-discretionary means that the Congress does not have to meet and agree for this fiscal policy change to happen. We call these automatic stabilizers, or sometimes built-in stabilizers, and specifically that's changes in taxes that happen automatically and changes in government spending that happens automatically, specifically transfer payments. Let's talk about taxes first. This is an automatic stabilizer because when GDP falls, tax revenue also falls. That's because when GDP is falling, people's income are falling, and so their income taxes are falling. So taxes automatically decrease when GDP decreases, and the vice versa is true. So when GDP is increasing, then taxes automatically increase. Now, before I talk about transfer payments, I want to go a little bit more into detail about the tax system, because there's really three different types of tax systems. One is the progressive tax system. This means the higher the income is of the individual, the higher percentage taxes that they pay. This is how our income tax system is set up. So if you have a very low under the threshold income, you'll actually pay 0 in income taxes. The higher your income becomes, that percentage that you pay will go up, all the way up to 35% of your income will you pay in the income taxes. Another type of tax system is a proportional tax system, and that's where everyone pays the same percent taxes no matter what their income is. In this case, you can think about the sales tax. So we all pay the same 8.25% sales taxes, whether we're rich or we're poor. And then the last one, the regressive tax system, means that the tax rate actually falls as the income level rises. And a lot of people say, well, we don't use regressive tax systems in the US, but actually I think that the lottery is considered a regressive tax system because people with higher incomes don't pay the lottery. The lottery is actually a tax. It's just a voluntary tax. Whereas the lowest income level people play the lottery the most often of all of the groups. So proportionally, then the lottery tax is paid primarily by the lowest income group. So now you know the three different types of tax systems. How this relates to these automatic stabilizers is the more progressive the tax system is, then the greater the economy's built-in stability. So the progressive tax system, which is like our income tax system, provides the greatest automatic stabilizer. Now let's talk about government spending or public transfer payments. So public transfer payments vary inversely with GDP. What this means is that when GDP increases, then transfers or government spending will decrease and vice versa. So when GDP is falling, government spending increases. This happens automatically through only certain things. Specifically, I want you to think about unemployment benefits and welfare payments. So as GDP falls, there's more people on welfare and there's more people getting unemployment. So the government is going to be spending more money as they pay out the unemployment benefits and the welfare benefits. Now let's talk about the economic importance of the automatic stabilizers. What these will do is reduce the severity of business fluctuations. It's going to keep us closer to the full employment levels when we have a normal amount of expansions and recessions. Overall, during normal times, it just helps us to keep a more stable economy. Now, when we have a very large recession, like we did in 2008, 2009 with the Great Recession, or the recession that was brought on by COVID, obviously we're going to need more than just these automatic stabilizers. We need the government to come in and implement more fiscal policy. But in normal times, we can rely on these automatic stabilizers. In this slide, we're looking at the U.S. fiscal policy from 2000 to 2018. There's actually two different columns here. I don't want you to worry too much about it. This is the actual deficit and surplus amount. So this is how much tax revenue is greater than spending. If we have a positive number, or if we have a negative number, then that means government spending was larger than tax revenues. This cyclically adjusted deficit or surplus takes out the fact that we have these business cycles. The book goes into a lot more detail about this cyclically adjusted deficit or surplus, but I'm not too worried about that. What I want you to see here is what it's looked like in the past 20 years in the US. So notice here that almost all of these numbers are negative. So I mentioned earlier in the last lecture that the last time we actually ran a surplus was in 2001 here. For most of U.S. history, the government has spent more than it's brought in every year, and that's why we have all of these negatives here. You can also see the larger numbers happened during or after the Great Recession. So we have 9.3, 8.3, 8.1. And that shows that the fiscal policy that year was expansionary. They were spending a lot of money, they were cutting taxes or giving tax breaks or tax refunds to try to help pull us out of the Great Recession. Since this data ends in 2018 and fiscal policy had a very interesting year in 2020, I would suggest you take the time to click the link that I left in the notes. That has the most updated fiscal policy deficit numbers. So when you get to the homework, you will be doing a problem sort of like this. You'll be solving for the deficit and then the debt as well, which we'll talk about in the next lecture. What you want to remember is the deficit or surplus is per each year, and to solve for it, you just take the tax revenue and then subtract the government spending. The positive numbers are a surplus, and then the negative numbers are a deficit. When we get to calculating the debt, what you would do is just add up every single row. So the debt is the total accumulation of all the deficits and all the surpluses from every year. Now let's talk about some of the main problems with fiscal policy. The first one is timing issues. The main idea being here that fiscal policy can be very, very slow to help. So unless it's a very significant recession, then we may just want to wait it out and the economy will recover by itself. So there's three different timing issues. The first one is called the recognition lag. This is the time between the beginning of the recession or inflationary period to the point where we're aware that we're in a recession. Because of the time it takes for the economist to gather all the information and put it together, it can take 3 to 6 months before we actually realize that we're in the recession. That's the recognition lag. The second one is the administrative lag. This is the time between we've realized we need fiscal policy because we're in a recession or inflationary period. The time between when we realize it and when the action is actually taken. So remember with fiscal policy, if we're talking about discretionary fiscal policy, it's Congress who needs to enact the laws. So however long it takes for Congress to decide to take action and then to come up with a plan and then to enact the plan, That's the administrative lag. And this could take months or it could take years, depending on how long Congress takes to decide and agree. The third is called the operational lag. This is the time between when the action is taken, so they make a change in policy, and when it finally has an impact on the economy. So if we're talking about fiscal policy, let's say the government decides to increase government spending. They're going to build a new highway. So they put in the policy, they're going to build a new highway. How long does that take before they finally get started? And that highway build is going to take years and years after that. So it'll take at least months before we even start to see some impact from all the additional government spending, and that impact will continue as long as that highway is being built. So when we put together the recognition lag, the administrative lag, and the operational lag, by the time all of these three have occurred, the recession could already be over. The next big problem with fiscal policy is that it can be very based on politics primarily. So because fiscal policy is suggested by the president and then enacted by Congress, a lot of times what we'll see in election years specifically, there's expansionary policies happening, whether the economy is in a recession or not. If a certain political party can increase government spending or give a tax break, they're more likely to be reelected. The next one is future policy reversals. What this means is that if fiscal policy is temporary, it will be less effective. So for instance, if the government gives a tax reduction only for that year, or maybe only for 2 years, instead of going out and spending the tax break, then households will save it instead. And if they save it, it doesn't have any expansionary effect. The next problem of offsetting state and local finance is the fact that state and local governments have to have a balanced budget. The federal government does not, which is why they're able to run surpluses and deficits, or able to run deficits for 20 years like we have been doing. This isn't true for state and local finance or state and local governments. So what will happen is that the federal government is able to use expansionary fiscal policy, but at the same time, the state and local governments, because of the balanced budget, will need to be running contractionary fiscal policy, and those can cancel each other out. And the last problem is the crowding out effect. And I want you to put a star by this because the book really downplays how important the crowding out effect is, or how harmful it can be. So this is what the crowding out effect is. Number one, the government increases their spending, and they do this by increasing their borrowing. So the government is increasing their borrowing. Because of that, interest rates increase. So interest rates are increasing. When interest rates increase, remember that investment decreases. So what's happening is because of increases in government spending, there's going to be decreases in investment. So businesses aren't investing, they're not purchasing new capital. So a portion of this fiscal policy is going to be offset because we're having increases and decreases in spending at the same time. But it also causes harmful effects for our future. Remember that increasing investment and increasing our capital is one of the main ways that we can have future economic growth. So we're trying to help out our economy in the short run to get out of the current recession that we're in, but we're actually harming the country in the long run by decreasing the amount of capital accumulation and investment. So make sure you've got written down somewhere, the crowding out effect is increases in government spending, causes increases in interest rate, which causes decrease in investment. Now we're going to end with this example of practicing graphing fiscal policy. So you have information about the economy, but it's broken up into the pieces: consumption, investment, government purchases, and net exports. So you'll find your equilibrium GDP. It also gives you the full employment level of GDP is 600 billion. I want you to draw a graph depicting this economy. So you're going to see the economy is either in a recessionary gap or an inflationary GDP gap. So take a look back at your notes from the last lecture if you need to, where we went over this. So draw the graph, decide if the economy is in a recessionary or inflationary GDP gap. Then what will the government do about it? Are they going to use expansionary or contractionary fiscal policy? And what two specific actions will they take to correct this gap? So pause the video here and try it. The first step in this problem is to find your equilibrium GDP by adding up all the pieces in the economy currently. So if you add together C plus I plus G plus XN, you would have gotten 550 billion. And this is your equilibrium GDP. If we compare this to the full employment level of GDP, you can see that the equilibrium GDP is too low. That means that the economy is in a recessionary gap. So that's actually the answer to number 2. The economy is currently in a recessionary GDP gap. And I drew the graph out right here. This is what the economy looks like when it's in a recession. So I have my aggregate demand, my original aggregate demand, which I just labeled as AD full employment. That's going to cross aggregate supply right at the 600 billion. But currently, the economy has a lower aggregate demand than that. So my AD1 right here, this is where the equilibrium GDP is at 555 billion. So you should have 2 AD lines. One is too far to the left. So there's your graph. Number 3, will the economy use expansionary or contractionary fiscal policy? We want to use expansionary fiscal policy since we're in a recession. And what 2 specific actions will they take? They will increase government spending and decrease taxes. This concludes our discussion about fiscal policy. In the next lecture in this chapter, we are going to talk about the results of the fiscal policy that we've used for the last 20 years in the U.S. and discuss the U.S. public debt.